Uh, Good afternoon, everyone, and thank you, PMS Bazaar, for the opportunity. I was just mentioning to someone, it's quite ironic that we have our first physical event after 2 years and the tech gives up. Uh, Good afternoon to all the digital viewers as well. So we had the first session where Ashish covered why alternates. We had the second session which spoke about capital protection, and I kick off the next series talking about returns. So just to start off, what we've tried to put together for you today is what are the possible themes or investment opportunities that can open up in the coming 5 to 7 years to 10 years. What we've also done is taken a historical context, so let's kick it off. So I wrote about this somewhere in Feb 2019, where I mentioned that this decade has the potential to be India's decade. Why do we say so? I think the first and the most important thing, and this is a little underappreciated considering the fact that we're living this journey, there are about 200 countries in the world whose economic data is published by the World Bank. Only 9 countries, have made it past the $2 trillion GDP mark. More importantly, from 2 to 3, only 4 did it. And just 3 made it past $5 trillion. So this is not a very easy journey. Just 1.5% of the entire world makes it to the $5 trillion mark. So when we are making that journey in this decade, it's quite a big feat for us. Just to give you a perspective, this journey of 2.5 to 5, US did it in 10 years, from 1979 to 1988. And as you can see, S&P in that time was nearly up 5 times. China obviously had this Goldilocks period of global growth, where, I'm not sure if you're ever going to see that kind of phase again, where everything was doing well. China did it in 5 years, and even in that 5-year period alone, Chinese indices were up nearly 3.5 times. Now, what is required, right, for any country to go from 2.5 to 5? One of the questions that you can ask yourself is, why didn't some of these countries make it to 5 trillion? The biggest reason that we have discovered in our analysis is demographics. Probably the single biggest reason why some countries are unable to make the leap is demographics. India, thankfully, is right now in the demographic dividend period. This is an interesting chart by GAFCAL Research. The yellow line is the number of households who are, for want of a better word, poor. As you can see, the yellow line now dips below the bars, which are not poor households. So somewhere, assuming you take away the impact of COVID, we are a country where we've actually, for the first time, maybe since British rule, have more non-poor households than poor households. And this is a significant data point. This is where this whole middle class we talk about in China of 2004 to 20 is now going to play out in India. And in the next 5 to 7 years, as we have economic prosperity and per capita GDP goes up, you can see the yellow line may actually be smaller than the affluent bar, which means we could have more affluent people in India than poor people. The second aspect is, where do these people earn from? And they have to work for it, right? So again, in about 3 or 4 years, India will have more people working than China for the first time again, as far as the data goes back. And more importantly, we are having it a cost which is much lesser than China now. So just to give you a perspective, if you were to go back to, let's say, 2005, where the gap between the wages was actually, China was cheaper than India and actually had nearly 10 times the labor force that India had. And look at the journey that's happened over the last 15 years and what can happen over the next 5 years. So this is really the trend number 1, which is demographics, opportunity, there's work, and democracy. Something that we kind of underestimate living in the country that we live. All these 3 factors put together gives us the first trend, which is productivity. The second is cyclicals. You need to have some cyclical tailwind as well when you're trying to invest, especially in... so our job as equity investors is to invest in companies which make profit, because at the end of the day, we get a share of the profit. So you need to have some cyclical factors. As you can see, corporate profit to GDP is nearly at I think 18-year lows. Very difficult to go below that. Just to give you a perspective, US corporate profit to GDP last year was a staggering 10.5%. Right? India is at 2.6%. And the long-term average is about 5.5. So, if you were to think about what could happen to corporate profit in India, your profitability can go up 2 times and GDP grows at about 10%. So, you effectively have, in a period of 7 years, you could have 4 times the corporate profit that we have today, right? So, twice from profitability, and the GDP itself grows at 10%. So this is the second trend. We think that a strong bounce back in profitability will lead to higher share of corporates entering or reinvesting back into the formal economy. The third, this is one of my, I would say, most favorite analysis that I have done, which is quite staggering. So what we did is we took the dollar returns of all the big markets and gold, because those are where we can invest, and we charted out decadal returns, right? This is not made up data. It looks made up, but it is not. It's real data, but it is quite stark, right? As you can see, in decade of 70s, gold was the best performing asset class. Also psychologically, why maybe my parents always wanted to invest in gold, because they saw something go up 15 times in front of their eyes in a decade, right? Gold became the worst performing, then 80s was Japan, and you can see the yo-yo trend that continues. Today, we run India's largest NASDAQ fund, and we have more money coming in through the doors in the NASDAQ fund than we could have ever imagined. I'm not surprised, because the last 10 years, the best performing asset class in the world has been NASDAQ, right? It's up nearly 5 times, when India has been one of the worst performing asset classes, actually up just 70%. Right? This is the dollar term. So in a decade, Nifty has returned 70% in dollar terms. So again, I believe from an equity market perspective as well, this could be India's decade. See, it's very difficult to go from worst to again worst, right? It's actually not happened, at least in history. So I would bet that India could become the best. What have we learned from these 2 decades? One of the philosophies that we have at our firm is you can only know what is in the future if you look in the past. So the first decade was USD 500 billion to 1 trillion, where we really became a country of any force. Where $1,000 per capita is just subsistence income. So that's what we reached. How did we reach there is interesting. 40% of it was capex, right? Which is GFCF. And 50% was private consumption. The interesting thing is, within the 40% capex, 50% of this was done by the private sector, right? So effectively, 20% of India's GDP was run by the private sector capex and 50% by private consumption. Move over to this journey, you can see the difference. Just 25% came from capex and 60% came from private consumption, right? So it was a consumption-led economy. When we talk about India has been a consumption-led economy, what do we mean? This is what we mean. The other interesting aspect, as you can see, 25% that we see in GFCF, which is capex, most of it again was done by households, right? So effectively, in the last $1.5 trillion, all the heavy lifting was done by people like us sitting in this room, right? Private corporates were struggling, government was battling inflation and fiscal deficits, and they really didn't have the balance sheet to do anything. Now, there is a point that we have come today. You look at capacity utilization data that's released by RBI. If you smoothen out the COVID impact, both on the up and the down side of the bullwhip, it is clear that we are hitting capacity utilizations where capex needs to come in. And that's what we think. We think that over the next decade, industrialization will be a big theme. May not be as, consumption will still dominate the economy, but the delta will actually come from industrialization. What do we mean by industrialization? It would mean spend on infra, capex by private and the government sector. This is our vision. We reach $5 trillion by FY 27-28. Our Honorable Prime Minister's target is FY 24. I think that's a tough challenge, but even if we do it by 27, I think we would have done a great job. The last aspect, this again is quite interesting, is, we talk about household savings in India. If you look at the last 10 years, you could see that the household savings have gone from about 500 billion to 800 billion, which is only up about 60%, while GDP has doubled, right? So, which effectively meant that a lot of our savings was either consumed away by inflation, or we invested that savings into physical savings, right? Mostly real estate. Inflation targeting is one of the more powerful reforms done in India by the government and the RBI. And I think once this takes place and is effectively in place, the next 7 to 10 years, our household savings could actually outgrow our GDP growth. And that in itself brings in a different set of investment opportunities. Which is the fourth trend. We strongly believe that not only will savings be much faster than what it has been in the last 10 years, but it will also be more financial in nature than physical in nature. So just to put all this together, we came up with this acronym, IDUF. These are the 5 themes that we believe will play out. I'll just take a few minutes and kind of run you through them. So from productivity, we got urbanization, because at the end of the day, 50% of India's population resides in its villages and agriculture, and only 20% of GDP. So the fallout of higher productivity is actually urbanization. So we have digitization, industrialization, urbanization, financialization, and formalization. Industrialization, we already gave you a perspective on why we believe it will happen in this decade. This is just a cyclical representation of what happens. We've gone through this cycle in the past, to 98 to 2002. If any of you have lived that, I for some reason had a front side view of it, and it was post the Asian financial crisis, and the entire commodity sector in India went nearly bust. You had very similar NPA conditions then, just that it was not publicized because most PSU banks are not listed, so we don't read about them. But actually the NPA number of the banking sector was exactly the same at 11% in 2001 as it is peaked out in this cycle. So, as NPA gets cleaned out, the banking sector gets back its balance sheet in order, corporates get cleansed, the capex cycle starts again. Two of the other important, I would say, reforms which may be not getting due credit are PLI and the NIP and the NMP. Why PLI? To me, this is as landmark a reform in India as maybe GST or UPI, because this is the first manufacturing reform where the government is rewarding scale, right? Up until now, all government incentives were only for smaller scale, right? I'm sure you have friends and you have partners who break down their businesses so that they pay lesser tax or they get more incentives, because all the government incentives were for cottage, SME, MSME. This is the first manufacturing incentive program where scale gets rewarded. And if you want to become export competitive, you need to have scale. NIP and NMP, which is the National Investment Plan and the National Monetization Plan, has just been released. The numbers are so big that it becomes a little bit of a joke. But I think the intent is very important. The government has realized that during the construction phase, you cannot have private sector owning the project. It has to be owned by the government. Once the project is completed, private sector is great at running the project. So this combination of NIP and NMP should lead to acceleration of infra. Digitization, I think this is the theme which has been spoken about the most already, thanks to all the IPOs. But I just want to kind of show you two aspects to it. One is what is happening with us as investors and customers, and second, the 1998 revolution that started. So first, the B2C stack, I think that is a phenomenal stack in India. It's the only B2C stack in the world which is free. The B2B stack, Mr. Nandan Nilekani himself calls the GST and the Open network as big a moment as the UPI. And third is, we still don't have monopolistic companies yet. So there is a lot of disruption possibility. And lastly, unbundling is the future according to us. Now coming to IT exports, I don't know how many of you know this, but we actually export more IT than Saudi exports oil, right? So that's how big this industry is for us, and unparalleled IT engineer pool. And as I say, it's designed in USA, produced in China, but programmed by India. Coming to urbanization, this is very simple. As I said, India's productivity problem can only be overcome as we move people from villages to cities. India was more urbanized than China, but obviously now the gap is huge. As you can see on the right chart, this is the first decade since 1980 where number of villages have actually come down in India. So the first sign that maybe urbanization is picking up. Formalization, this is not big becoming bigger, but everybody becoming formal, right? There's a big difference between the two. I'm a believer in formalization than big becoming bigger. Why formalization? Because finally in India, if you're formal, it's better than not being formal. And I think that is what will lead to entrepreneurs becoming formal. As you can see some data, the growth rates of new firms are already showing that formalization is already picking up in India, and annual new business registrations are at all-time highs. Just lastly, with financialization, what we covered, this is just a representation of how physical savings actually picked up in the last decade, and now financial savings are kind of merging with physical savings. So what Ashish Somaya mentioned, that this is not only will India do well, but capital markets in India will do better. That's all. Thank you. That's my time. Thank you so much.